Set it and forget it. That's the dream, right? But where you park your $100,000 matters more than most people realize. In fact, it could be the difference between retiring with a $2 million portfolio or a $4.9 million portfolio, a difference of $2 million when it comes to putting that money in VIG versus SCHD, both dividend-focused ETFs. In this video, I'm going to break down the differences between VIG and SCHD. Which one grows your portfolio faster? I'll break down their performance, compare their strategies, and help you and John decide which ETF might be the better choice for your $100,000 investment. In the end, I'll show you the side-by-side projection of both ETFs and reveal which one could deliver over $4 million in a retirement portfolio and which one pays over $30,000 in monthly dividend income. But before I get into the numbers, let's get clear on what VIG and SCHD actually are, because while they fall under the dividend ETF umbrella, they go about things in very different ways, and those differences make a huge difference to your long-term results. Let's start with VIG, short for Vanguard Dividend Appreciation ETF. It's been around since 2006, managed by Vanguard, arguably the gold standard when it comes to long-term, low-cost investing. It tracks the S&P U.S. Dividend Growers Index, which includes companies that have increased their dividends for at least 10 consecutive years. That's a high bar to clear. If a company misses just once, it's out. So this ETF is built around consistency and slow but steady wealth building. On the other side, there's SCHD, the Schwab U.S. Dividend Equity ETF, launched in 2011. It's built to track the Dow Jones U.S. Dividend 100 Index, which focuses on companies that not only pay high dividends but also pass strict screens for financial health. It starts by filtering for U.S. companies that have consistently paid dividends for at least 10 consecutive years. Next, SCHD applies a series of financial health screenings to assess the quality of these companies. These include evaluating the ratio of free cash flow to total debt, return on equity, dividend yield, and the 5-year dividend growth rate. Each company is scored based on these metrics, and the top 100 are selected for inclusion in the index. So, unlike many high-yield funds, SCHD isn't chasing risky payouts, it's curating a list of companies with both strength and income. In terms of scale, VIG is the bigger of the two, with over $101.79 billion in assets. SCHD isn't small either, it manages around $67.51 billion. These sizes bring liquidity, stability, and trust from long-term investors. And when it comes to costs, you're in good hands. VIG charges just 0.05%, while SCHD comes in at 0.06%, meaning you keep more of your returns. Both are designed to reward long-term investors, but the way they do it and what they prioritize is slightly different. Now that we know what VIG and SCHD aim to do, let's zoom in and see how they do it, starting with companies they actually invest in, because at the end of the day, it's the mix of businesses inside that shapes your returns, your income, and how stable your investment journey feels along the way. Starting with SCHD, this ETF holds 103 stocks, a fairly compact portfolio by ETF standards. But that's the point. SCHD doesn't aim to be overly diversified. Instead, it focuses on picking companies that check off multiple boxes: strong return on equity, solid free cash flow, healthy dividend history, and low debt. It wants quality over quantity, and that leads to a sharper, more concentrated lineup. SCHD's top sector is consumer defensive with 19.7%, followed by energy at 19.39%, healthcare at 14.26%, and industrials at 11.09%. You'll also find exposure to technology, consumer cyclical, and financials. This sector mix reflects SCHD's tilt toward reliable, cash-generating businesses, ones that keep earning and paying dividends regardless of market mood. Now, if you look at the top 10 holdings, you'll see the same story. Names like Verizon, Coca-Cola, Altria, ConocoPhillips, Lockheed Martin, Home Depot, and Chevron show up near the top. Together, these top 10 holdings make up over 41.15% of the entire fund. That means SCHD is pretty top-heavy. When just a few of those companies move, they can pull the whole ETF up or down. Now, compare that to VIG, which is built with a completely different approach. VIG holds 341 companies, making it far more diversified. This ETF leans heavily into technology at 23.1%, financials at 22.55%, and healthcare at 17.78%. Other sectors include consumer defensive, industrials, and smaller allocations to consumer cyclical, basic materials, energy, utilities, and communication. VIG's top 10 stocks read like a who's who of long-term winners. You've got Apple at 3.89%, Microsoft 3.87%, Broadcom 3.61%, JP Morgan Chase 3.58%, Eli Lilly 3.38%, Visa 2.9%, Exxon Mobil 2.71%, United Healthcare 2.5%, MasterCard 2.33%, and Costco 2.17%. These companies represent 31.05% of the total portfolio, so while still impactful, they don't dominate the fund like SCHD's top names do. So what does this mean for you? In simple terms, SCHD's heavier weight in the defensive and energy sectors makes it feel more stable during rocky market periods. VIG's exposure to tech and financials can be more volatile, but it also opens the door to stronger long-term price growth. So they're built on different philosophies, and understanding why they hold what they hold is where the story gets interesting. In the end, I'll show you the side-by-side projection of both ETFs and see which one can reach over $4 million and which one could pay around $30,000 in monthly dividend income. Back to the comparison. Strategies are great in theory, but what really counts is how they perform when the rubber meets the road. So, how have VIG and SCHD actually done in the real world when it comes to historical performance? Let's kick off with the most recent one-year return. VIG is up a solid 8.91%, while SCHD is down slightly 0.34%. That's a noticeable gap. Tech and growth stocks, which make up a large chunk of VIG, bounced back strongly after a volatile trade war event. SCHD, on the other hand, with more defensive names and energy stocks, lagged behind in price action. Now zoom out to the 5-year window. SCHD has gained 59.34%, while VIG is up 76.61%. Both ETFs have navigated through a roller coaster of macro events, rate hikes, inflation fears, sector rotations, but VIG's composition gave it a performance edge. With a larger share of tech and financials, VIG captured more upside during bull markets, while SCHD's heavier reliance on income sectors held it back slightly. Go even further, 10-year returns. SCHD has returned 97.29%, a strong number by any standard, but VIG delivered 140.55%. That is a 43-point spread. Over a decade, that difference really compounds. The data here is crystal clear. VIG has consistently outperformed SCHD in total price return across every major time frame. But returns aren't just about price movement. Income plays a huge role as well. And this brings us to a really important distinction: yield versus growth. SCHD has a higher dividend yield, currently around 3.5%. That means for every $100 you invest, you're getting about $3.50 in dividends per year. It's solid income right out of the gate. VIG's yield is lower, closer to 1.85%, so you're getting less income up front. Over the last 10 years, VIG's dividend growth rate has averaged around 7.54% per year. SCHD, closer to 11.3%. So SCHD's dividend growth rate is higher, and it's growing from a higher base. So depending on your time horizon, one may outshine the other. But here's the thing, returns and income are only part of the story. The real question is, how does it feel to hold these funds when the market gets bumpy? Let's start with volatility, the day-to-day ups and downs that can shake investor confidence. SCHD tends to be the calmer of the two. It leans heavily on consumer defensives, energy, healthcare, and industrials, sectors known for stable earnings even in rough markets. This helps cushion SCHD when the market drops. It's why during corrections, SCHD doesn't fall as far and stabilizes quickly. But lower volatility also means fewer wild surges. SCHD is built more for smooth and steady. VIG, by contrast, is more sensitive to market cycles. It's heavier in tech and finance, two sectors that tend to rise fast in bull markets, but also swing hard in pullbacks. During the same 2025 correction, VIG dropped further than SCHD, but it also rebounded faster. So while it comes with more volatility, it also offers more upside if you can stomach the swings. When it comes to reliability, both ETFs are incredibly consistent. SCHD has grown dividends every year for over a decade. Its payout is predictable, and the companies inside it are selected for financial strength. Even in economic downturns, SCHD delivers income you can count on. VIG is just as reliable, but with a different flavor. It prioritizes dividend growth, not just payout, so while the current yield is lower, you can count on that number rising over time as long as you stay invested. VIG also focuses on companies with a 10-plus year dividend growth streak, which gives it a high bar for quality and consistency. In terms of risk-adjusted performance, both have done an excellent job of rewarding investors without exposing them to unnecessary drama. SCHD might be better for conservative investors looking for income and less volatility. Meanwhile, VIG is great for long-term builders who don't mind a few dips along the way. Now let's move from theory to real-life numbers. What happens if you or John invest $100,000 into each of these funds and just let them run for the next 30 years? Let's break that down and see just how far your money could go. Let's start with VIG. For investing purposes, it has a dividend yield of 1.85%, a 10-year dividend growth rate of 7.54%, and a consistent annual share price appreciation of 9.2%. So, if you invest $100,000 into VIG today and simply let it grow, here's what happens. In the first year, your $100,000 would nudge up to around $111,050. After 10 years, that balance would grow to $281,844. Keep going, and by year 20, it'll be valued at $775,604. Stay the course for 30 years, and you're looking at a projected portfolio value of $2,091,567. By year 30, this portfolio will be paying $21,582 a year in dividend income, which breaks down to around $1,799 a month. The total value of the portfolio will be $1,991,567, with $1,743,508 coming from capital appreciation and $248,059 from reinvested dividends. The big question is, can SCHD beat that? Well, let's find out. Plugging that same $100,000 into SCHD leads to a very different arc. It has a higher starting dividend yield of 3.5%, a faster 10-year dividend growth rate of 11.3%, and a steady annual share price growth of 7.09%. So if you invested $100,000 today, by the end of the first year, your portfolio would be worth around $110,590. Stay invested for a decade and that number climbs to roughly $292,554. Let it run for 20 years and you're looking at $1,037,608. Give it the full 30 years and your investment would soar to $4,888,211. After 3 decades, SCHD would be generating around $476,734 a year in dividends alone. That's $39,728 a month, and all without selling a single share. The total value of the portfolio will be $4,788,211, of which about $2,083,816 comes from capital appreciation and $2,704,396 comes from reinvested dividends. So when it comes down to it, VIG or SCHD, which one actually wins? Let's break it down by the numbers after a $100,000 investment over 30 years with no additional contributions. VIG grows your money to about $2.09 million. That includes around $1.74 million in capital appreciation and $248,000 from reinvested dividends. By year 30, you're earning about $21,582 per year in dividend income, or around $1,799 per month. SCHD, on the other hand, doesn't just grow, it explodes. That same $100,000 investment turns into about $4.89 million. Roughly $2.08 million comes from capital appreciation matching VIG growth, but an incredible $2.7 million comes from reinvested dividends. And the income? You're looking at $476,734 a year in dividend payouts by year 30. That's nearly $40,000 a month in cash flow. So while VIG is more diversified and quick to bounce back, SCHD is the clear winner if you're focused on total return and passive income potential. It offers nearly 2.5 times the ending portfolio value and over 20 times the annual dividend income in year 30 compared to VIG. Bottom line, if your goal is to build a massive portfolio with life-changing income in retirement, SCHD absolutely takes the crown. Want to know how to turn $100,000 into a $10 million portfolio? Click the video on the screen to find out.